Welcome to StockTok's deep dive into Marathon Petroleum Corp. Marathon Petroleum is one of the largest downstream energy companies in the United States, operating an extensive network of oil refineries that convert crude oil into gasoline, diesel, and other refined products. At the time of recording, the stock is trading at 213.69, situating it closer to its 52-week low of 124 than its 52-week high of 255.77. The 50-day moving average sits at 220.23, just above the current price, while the 200-day moving average rests at 189.29, meaning the stock is below its near-term trend, but still above its long-term structural baseline. The RSI, or Relative Strength Index, a momentum measure on a 0 to 100 scale, reads 38.4, sitting in neutral territory but edging toward oversold conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Marathon Petroleum Corp operates as a leading independent petroleum refiner and marketer in the United States. Its core revenue engine is refining crude oil into transportation fuels, which it distributes through its MPLX midstream partnership and its retail and wholesale networks. The competitive moat, in our view, rests primarily on scale, asset complexity, and geographic positioning of its refineries. The StockTok score comes in at 53 out of 100, signaling a hold. Valuation scores strongest at 17 out of 20. Financial health earns 16 out of 20. Profitability is the weak link at just 4 out of 20. Growth scores 8 out of 20, and smart money checks in at 8 out of 20 as well. Now, valuation. The question every investor has to answer: are you paying the right price? Marathon Petroleum's trailing price-to-earnings ratio, the multiple investors are paying for each dollar of past earnings, stands at 16.01 times. That is a modest multiple for an energy refiner, and not one that screams excess on its face. The forward price-to-earnings ratio, which uses next period's estimated earnings, drops sharply to 6.15 times, suggesting the market is currently pricing in a meaningful earnings recovery. The PEG ratio, which adjusts the price-to-earnings multiple for expected growth, registers at 0, a figure that warrants careful interpretation rather than a clean read. The EV/EBITDA multiple, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, a capital structure neutral valuation yardstick, comes in at 8.91 times, which is broadly in line with where integrated and independent refiners have historically traded. The price-to-sales ratio sits at 0.50 times, a low multiple that reflects the high revenue, thin margin nature of the refining business. Turning to intrinsic value, the Guru Focus value, a proprietary estimate of fair value, is 191.32 at the time of recording, implying the stock trades at an 11.69% premium to that estimate. So by this measure, there is no margin of safety. In fact, it is a slight overvaluation signal. Wall Street analysts at the time of recording have a consensus mean target of 246, drawn from 18 analysts, with a range from 174 on the low end to 331 on the high end. A wide dispersion that reflects genuine uncertainty about the refining cycle. The next earnings report is due in early May of next year, with the street expecting earnings per share of approximately 1.14. though the range runs from 0.55 to 3.25, a remarkably wide band, and itself a near-term catalyst to watch. On the competitive moat, in our view, Marathon Petroleum benefits from scale and asset density rather than from pricing power or intangible assets. The refining business is fundamentally a spread business, and margins are driven by the crack spread, meaning the difference between crude input costs and refined product prices. Market sentiment around Marathon Petroleum, as of the creation of this video, leans neutral, with insufficient recent news flow to push the signal in either direction. On balance, the valuation setup looks modestly interesting to us, particularly on a forward earnings basis. but the guru focus premium and the profitability pressures we will discuss shortly counsel against treating this as a deep value entry. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that tests profitability signals, leverage trends, and operating efficiency improvements, comes in at 8 out of 9. That is a high reading, and it tells us that across most of the fundamental health criteria that academic research associates with financial improvement, Marathon Petroleum is scoring well. The Altman Z-score, a multi-factor bankruptcy probability model, where scores above 2.99 are considered safe, registers at 3.28. The company is firmly in the safe zone on this measure. Now, the debt picture deserves attention. The cash-to-debt ratio is 0.11, meaning the company holds just 11 cents of cash for every dollar of debt on the balance sheet. That is a thin liquidity cushion against debt obligations. Interest coverage, the ratio of operating earnings to interest expense, a core solvency measure, stands at 4.07 times. That is serviceable, but it leaves a narrower buffer than we would ideally want, particularly in a cyclical industry where earnings can deteriorate quickly in a down cycle. The current ratio, current assets divided by current liabilities, a near-term liquidity gauge, is 1.26 times, indicating the company can cover its short-term obligations, if modestly. Debt to equity is 1.98, meaning the company carries nearly $2 of debt for every dollar of equity. That is a meaningful leverage load. In our view, the balance sheet reflects a company that manages its debt actively, but operates with limited financial flexibility, a characteristic common among capital-intensive refiners. The high Piotrowski score is reassuring, but the leverage and thin cash coverage are genuine constraints worth monitoring. Next up, profitability. Is this business actually making money efficiently? This is where the scorecard gets challenging for Marathon Petroleum. Return on invested capital, the return the business generates on all the capital it has deployed, a fundamental measure of value creation, comes in at 7.79%. For context, a business is generally considered to be destroying economic value if its return on invested capital falls below its cost of capital, which for a company of this risk profile is typically estimated in the high single digits to low double digits. So this reading sits right at the boundary, neither clearly value-creating nor clearly value-destroying. And it is one of the key reasons profitability scores only 4 out of 20 in the StockTok model. The gross margin, the percentage of revenue left after direct production costs, is 7.54%. That is a thin number, but it is structurally typical of the refining industry, where raw material costs, crude oil, dominate the cost structure. Operating margin narrows further to 4.35%, and net margin, the bottom line earnings after all expenses, interest, and taxes as a share of revenue, stands at 3.05%. Free cash flow margin, the proportion of revenue that converts into actual free cash after capital expenditures, is 3.59%. That is slightly above net margin, which is a mildly positive sign suggesting capital discipline at the asset level. In our view, these are structurally thin margins that are highly sensitive to the crack spread environment. Profitability here is a function of macro commodity conditions as much as operational excellence, and that cyclicality is the central risk any investor in this name must fully absorb. Onto growth. Is this business expanding, and at what rate? The revenue growth picture for Marathon Petroleum is a study in contrasts. Over the trailing 5 years, the company has grown revenue by 30.6% in aggregate, a meaningful expansion that reflects both volume growth and the dramatic commodity price cycle that swept through the energy sector during that period. However, looking at the more recent trailing 3-year window, revenue has contracted by negative 9.2%. That deceleration is significant. It tells us the 5-year number is heavily influenced by the commodity price spike that inflated refinery revenues at its peak, and that the more recent trend is one of revenue compression as crack spreads normalize. Book value per share, the net asset value of the company on a per-share basis, after liabilities, has declined by negative 1.3% over the trailing 3 years. That is a modest deterioration, and in the context of aggressive share buybacks, which reduce equity on the balance sheet while being accretive per share, it is not automatically alarming. But combined with the revenue contraction, it reinforces a picture of a business that is not in a structural growth phase. The dividend yield stands at 1.79% at the time of recording. That is a modest but real income component, and management has historically used capital returns, both dividends and buybacks, as a primary mechanism for distributing excess cash flow to shareholders. In our view, Marathon Petroleum is best characterized as a capital return story operating in a cyclical commodity business, not a compounding growth story. Investors watching this name should be watching crack spread dynamics and capital allocation discipline as the primary value drivers. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier investment managers, the so-called gurus tracked by major institutional databases, currently hold positions in Marathon Petroleum. That is a meaningful number, reflecting broad institutional awareness of the name. Among the most notable, Bill Nigren of Oakmark Funds holds Marathon Petroleum as approximately 0.83% of his portfolio and has been adding to the position. Nigren is a disciplined, value-oriented manager with a long track record, and his continued presence and incremental buying is a data point worth noting, though it is one signal among many rather than a definitive verdict. Turning to broader institutional flows, only 8.8% of 13F institutional filers, 13F being the quarterly disclosure form that large investment managers must file with the SEC, are net buyers of the stock at the time of recording. A reading above 50% would signal net bullish institutional demand. At 8.8%, the data suggests that the preponderance of institutional investors who have filed are either holding steady or reducing exposure, not actively accumulating. That is a cautious signal from the aggregate institutional community. On insider activity, management and board members own just 1.36% of shares outstanding, a low ownership figure that, in our view, suggests limited direct financial alignment between executives and outside shareholders. Over the trailing 3 months, there have been 0 insider purchases and 3 insider sales. Insider sales alone do not constitute a bearish signal. Executives sell shares for many legitimate personal financial reasons. But the absence of any insider buying, combined with low ownership, means we do not see the conviction signal from management that we would ideally want to see in an institutional-grade setup. And finally, the verdict. Let's bring it all together. On valuation, the setup looks modestly interesting to us on a forward earnings basis, with a 6 times forward price-to-earnings ratio reflecting a market that is pricing in meaningful near-term earnings pressure. But the guru-focused premium and neutral news sentiment keep us measured in our enthusiasm. On financial strength, the Piotrowski and Altman scores are reassuring, but the leverage load and thin cash-to-debt ratio of 0.11 are genuine constraints that limit balance sheet flexibility in a down cycle. On profitability, this is the most challenging dimension, razor-thin margins at every level of the income statement, and in return on invested capital that sits right at the edge of the company's estimated cost of capital, leaving little room for error. On growth, the trailing 3-year revenue contraction of negative 9.2% and the normalization of the commodity cycle suggest this is not a structural growth story. It is a capital return and cycle management story. On smart money, the presence of 16 institutional holders and Bill Nigren's incremental buying are constructive signals, but the low 13F buyer percentage and the absence of insider purchases temper that read. On balance, in our view, Marathon Petroleum represents a cyclical energy refiner that scores reasonably on financial health and valuation relative to its history, but faces genuine headwinds on profitability and growth that the current price does not fully discount. The setup warrants a measured watch rather than aggressive positioning, in our opinion. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Marathon Petroleum Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.